Please stay tuned for important disclosure information at the conclusion of this episode.
This is Destination Retirement with Robert Kuhn from Kuhn Capital Partners. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Robert provides his clients and prospects the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful strategies to put you on the path to achieving your retirement goals. And now here is Destination Retirement with Robert Kuhn.
Welcome. Thank you for joining us. My name is Robert Kuhn. I'm the host of Destination Retirement and also the president, founder of Kuhn Capital Partners. We're independent. We're a registered investment advisory firm. Investors task us with building hyper-personalized portfolios that are designed for each of their unique cash flow, protection, and growth requirements. Our use of and ability to make capital investments in cutting-edge technology, I think it truly gives our clients a distinct advantage over traditional one-size-fits-all model portfolios that most advisors use. Our goal is to work with investors who want hyper-personalized portfolios that are tailored to only their specific goals and objectives. That is our main focus. If you have any questions, thoughts, or you'd like to get on our calendar to have an introductory conversation, we certainly can do that. You can call Paige at 630-492-1912, 630-492-1912. Our headquarters, we are in Chicago. Our office is in the western suburbs. We work with individuals across the country. If you're listening to this radio show, then we have a large presence in your area, and we want to make sure that we are here, or you know that we're here to help you. So 630-492-1912. So the Fed raised rates again, 25 basis points. I don't think that comes as much of a surprise to most individuals. It may to some. I think it has been pretty telegraphed. I guess the question I have is, why did they skip June? But July they raised, and I think they are going to continuously, well, who knows? I mean, one or two or three more rate hikes. I think we're towards the tail end of the interest rate increases. Inflation is certainly trending in the direction that we want. But I think, when we look at kind of where the market is today, I have a lot of concerns. I have concerns in many areas of financial planning, in many areas of asset management or financial advice. If you've listened to the show for any length of time, you know that we are very concerned with people who use model portfolios that are a one-size-fits-all. We're very concerned with distribution planning, with retirement planning, with income planning, with what percentage those individuals can take outside of out of their portfolio. Rather, I think many advisors who are using old technology, Monte Carlo, I think falls into that category, at least in our mind. You're really being limited on the distribution yields that ultimately you can take. So if you've listened to the show for any length of time, you understand that we have some concerns. Our job is to always make sure that we are providing, first and foremost, a fiduciary role. I think that's very important, especially in this market. We're not going to put down a piece of paper of hypothetical performance like many advisors do. Some that host radio shows will show you ridiculously strong performance. When you dive into it, you recognize that it's fake. Anything back tested is fake performance. It's not actual. It's not real. Hasn't been tested. And we hear it over and over again that we went with XYZ advisor because of the performance that they showed us, only to be disappointed. So, when we talk about hyper-personalized portfolios that are directly tailored to you and your unique cash flow, protection, and growth requirements, those are the things that we want to talk about today. If you do have a 401k, we're doing a lot of 401k money management. So if you have a 401k at Empower or Charles Schwab or Fidelity, there's a good chance that you have a self-directed option that you don't even know about. And if you do, then we can provide professional money management inside of your portfolio that has significant stop loss strategies, meaning they can go to cash when cash is needed to protect principal. So we don't often talk a lot about that on the radio, but I think the minimum for the 401k money management, because we're often asked, how much do I need to have to work with you? And on the 401k side, it's $25,000 is the minimum. We're going to help the $25,000 investor the same way we're going to help the $15 to $20 million investor. That's just who we are. That's our business. That's something that I'm very passionate about, making sure that you get the right cash flow, protection, and growth strategies in place, regardless of how much money you have. And that's something that we're never going to change. So, I want to make sure that you know that. But if you do have a 401k at Schwab or at Fidelity or Empower, many of the big companies here in Chicago have access to self-directed options. So let us help you. To get mathematical money management that has significantly outperformed the broader markets with significantly less risk since 2002. Inside of a 401k, which is somewhat limited as far as investment choices, I want to make sure that that there's a good chance that we can help you. So 630-492-1912. A couple things on the dual directional notes. We've gotten a lot of calls on that. We continue to do the dual directional notes. A lot of advisors won't tell you about them, won't share them with you because they're complicated. They're only complicated one time. And then once you understand it, which you get it pretty quickly, then I think you'll be really happy that, you took the time to understand that, there are institutional strategies now available to you that, we want to make sure that you at least know about. So the dual directional notes are phenomenal. We just did one actually that priced last week. JP Morgan was the grantor. So it's a JP Morgan note. Obviously very comfortable with JP Morgan credit. I don't think we have to worry about that. If we do, then there's a whole lot of other things that we have to worry about. But the cap on it for 15 months, which is really interesting, was almost 20%. So you're going to get maximum growth of 19.3. That's phenomenal. So over the next 15 months, you're going to get between 0 and 19.3 percent maximum growth. So if the index it tracks did more than that, you're capped at 19.3. So 0 to 19.3. I don't think the market's going to do more than that. But what most people absolutely positively love and don't understand how they can do it because it's an institutional hedging strategy. From 0 to negative 15, you actually get the inverse. So you heard me correct. So if the market the indexes that it tracks are down 15, you get positive 15. Down 7, you get positive 7. Down 2, you get positive 2. So from 0 to negative 15 in 15 months, you get the inverse. So the negative turns into a positive. How about that? I mean, that is just a phenomenal strategy for many people, right? I mean, especially if you're looking in that protection bucket or the hedge bucket. Most people, they just don't have protection. And you're sitting at the mercy of an advisor that's going to do nothing but tell you to sit and take it. And that's just not good enough. And not when there's investments out there that you can still make money when the markets are down. And then if the markets do go down substantially, meaning 15% or more, you start to lose money in this particular investment. So if the market, that the index that it tracks are down 16, you're down 1. 17, you're down 2. 18, you're down 3. So 0 to 15, you actually make the inverse. 15 and on, you start to lose money. So look at your 0 as negative 15. So look at your portfolio today. If you're working with an advisor, the simple question is, what do I have in my portfolio that will do well, that will deliver positive results if the markets are down? And if they don't have an answer for you, then call us, because you're not working with a proactive advisor that is utilizing cutting edge risk management tools from the largest, most successful, strongest financial institutions in the world. So 630-492-1912. 630-492-1912. So cash flow. Many of you know, if you've listened to the show, that as a firm, we made a capital investment in some cutting edge technology on distribution planning. Most people are still using Monte Carlo analysis, which is good as far as giving you the probability of success, but very, very poor on your income distribution. How much I can take? Can I take more? When do I have to take less? So if you're working with an advisor and you don't have a written income plan, or at least some sort of an income plan in place, we have to have a conversation. I would ask them, how are you determining my distribution rate? And what has to happen where I can get a pay raise? What has to happen where I need to take less money? And if they can't tell you that, or if they're talking about Monte Carlo or probability analysis, we need to talk. Again, as a firm, for our clients, for our potential clients, we've made a capital investment in some technology and some software that is the next evolution of Monte Carlo. It makes Monte Carlo look like, the first iteration, at least in our opinion, the first iteration of the iPhone versus today. So we can tell you, give you some guardrails of, okay, you can take X. And if the markets do this, you can take X plus, and then X plus plus, and X plus 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 plus, because a lot of individuals need to take and maximize their distribution. So I want to make sure that you know that is complimentary for us to run those reports for you. And we've found just great success in opening clients' eyes to, well, everybody just says you have to take 4%. Well, why and how? And what are they basing that on? On stale data, on data that stopped years and years ago, on an interest rate environment that, we weren't in today. Income planning, interest rates, first off, are dynamic. Markets are dynamic. And risk is dynamic. And so should be your distribution, and the money that you need to take from your portfolio, whether it's a little or it's a lot. We want to be able to put some scientific parameters or guardrails upon that to let you know that, listen, the markets were up huge this year. I can't tell you how many people have missed this rally because they say, well, the markets have to go back. They have to go down. And, the news flash is the markets don't have to do anything. They don't think, they don't feel, they just are what they are. So hopefully you're with an advisor that hasn't, been overly, conservative based on gut feel. Again, everything we do is based upon math and financial science and simply looking at the numbers, and gut feel, it just doesn't mean anything. So when it comes to cash flow and cash flow planning, I want to talk a lot about that today. I want to talk a lot about some tax advantage strategies. And then I just want to kind of just get into some random thoughts on who's reaching out, because if you've looked at, or if you go to, we podcast every episode. So you can go to the website and listen to our podcast, or you can go to any, Apple, Google, whatever. And we podcast every episode, but the numbers are up and to the right. And I contribute that to really two things. Hopefully, one, I know for a fact we're bringing a unique, hyper-personalized portfolio that others aren't. That, again, are, markets can go three ways, up, down, and sideways. The average traditional advisor, you're going to make money in an up market, lose money in a down market, and then who knows what's going to happen in a sideways market. We want to bring to the table strategies that can exceed market growth in the upside, still make money to a certain level in a down market. Then in a sideways market, we'll concede that we just don't know what ultimately is going to happen. But we know that we're bringing something to the table that is truly unique. And so I want you to listen to the podcast. If anything I say on the radio show resonates, do two things. Give us a call. Let's have that complimentary conversation, 630-492-1912, or visit the website, kuhncp.com. KUHNCP.com. And you can certainly listen to all of our past episodes. So we're going to have a great show this week. Thank you for joining us. And again, if you want to get in touch with us, give Paige a call, 630-492-1912. More after the break.
Would you like your portfolio to be more certain in uncertain times? These days, there are more questions than ever. Before we can get to the answers, we have a question for you. What do you want to accomplish? Understanding the bigger picture is the first step to helping you pursue your goals today, tomorrow, and for generations to come. To schedule a complimentary call with Robert, please call 800-674-3217. Again, that's 800-674-3217. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
Hey, welcome back. I'm Robert Kuhn. This is Destination Retirement. Thank you for joining us. If this is your first time, welcome. If you're a repeat listener, thank you. Hopefully you've shared the radio show with some friends, some family members, or the podcast link, because that helps us get our message out. As you know, I think investors, well, I know for a fact, investors task us and our firm as a fiduciary with building hyper-personalized portfolios that are designed for your specific and unique cash flow needs, protection needs, and growth requirements. I think through the use of technology, and we're able to integrate financial planning with portfolio construction, it truly allows us to deliver it simply is unique. And most importantly, it's hyper-personalized portfolio to every single one of our clients. And we can do it at scale. And we can do it at scale with technology. And that, to me, is a big deal, because the only marketing, for all intents and purposes, the only marketing that we do, or outreach, or whatever you want to call it, client acquisition, it's really here to help. And that is our goal. First and foremost is to help and make sure that, we'll talk about a client story here in a minute, but make sure that a couple things, that your unique cash flow, protection, and growth requirements are being met. And you don't know if they're not being met until it's too late. And especially with the markets where they're at, and many of the strategies that we've talked about a lot on the show, for example, the dual directional notes that can give you, the one we priced last week through JP Morgan was capped growth at 19.3%. It is a 15-month investment from 0 to negative 15. That's called the absolute return component, where you get the inverse. So if the market's down 10, you get positive 10. If it's down 15, you get positive 15. So from 0 to negative 15, you actually get the inverse, the positive return. And then lastly, negative 15 and on, you start to lose money. So if the market's down 16, you're down 1, 17, you're down 2, 18, you're down 3, et cetera. So a lot of great strategies out there that many people are just dumbfounded by. And it's just simply because they're not mass marketed. They're institutional in nature, brought to you by the biggest banks. It's not a stock or a basic bond. I mean, the legal structure is a bond, but it's something that is probably going to be unique to you and new to you. And advisors don't like new things, because it's hard to get new clients. They just want to show you hypothetical, back-tested performance that, looks magical, and then you find out that it wasn't real and it doesn't deliver. So, I think our job as advisors is to truly, as we talk about, especially in this, market environment, three things: cash flow, protection, growth. Cash flow, protection, growth. You may not need cash flow now, but you will need cash flow at some point. You may not need protection now, but you will at some point. What are your growth requirements? What are you utilizing to make sure that you can statistically put a number on a piece of paper that you can know that, okay, here's my probability of meeting my cash flow, my protection, or my growth needs. And so those are the things that we want to make sure, especially in this market, because I think the market's different. I like to say, I was talking with my son. He, runs a fund and is part, he's just a super great kid, and I love him. And clearly, hopefully we all think that about our kids, but we were having a great conversation last week in that a lot of the money today is hot money. And what that means is that a lot of the money today and a lot of the market today is momentum, and it's computer driven. And that is why you're seeing a lot of the names just continue to go up and continue to go up. Well, they can't go up 200%. Well, they can't go up 300%. Well, they can't go up 400%. Well, why? When you have money that's following them and money that is being invested, it just simply drives the price higher. And these aren't small stocks. I mean, these are huge, huge, huge companies. If you've seen the statistics, I'm sure you have. The Magnificent Seven, the seven, large tech companies that are driving this market. And if you've missed out on that, it's unfortunate. And if you're still using old style box investing, meaning you have an advisor that tells you a couple of things. One, you can't time the market. Well, that's 100% inaccurate. I mean, what are we talking about here? Are we trying to talk about timing the market tick by tick or minute by minute or second by second? Listen, there's a lot of people that can. I can't. And a lot of people can't. And most people can't. And those that can, they simply don't need our money. But that doesn't mean that you can't play defense. That doesn't mean that you can't hedge. You hedge in every area of your life. So if you're an investor and you're 55 plus or 50 plus, or if you're in retirement currently, it's a simple question. You have to ask your advisor, what bucket of my money will deliver and do well when the markets go down? And then just sit and wait. And just sit and wait for the answer. And if you can't get a specific bucket of your portfolio, I mean an investment, not, well, we think this or we think that. This is the investment that's going to do well if the markets don't. Here's a way that if the markets are down 15% or less, you can actually make money, make the inverse of those of what the markets do. That to me, we can, our clients, we can point to that. So if a client comes to us and says, where's my cash flow story? Well, here's your cash flow. What is cash flow? Cash flow is investments that are going to perform, at least in our opinion, independent of the interest rate environment and the stock market, meaning they're investments that can do two things. Number one, provide significant tax reduction. You sold a building, you sold a company. I don't care if you sold a company for $500,000 or $150 or $200 million. You're going to have a tax bill. Let's invest in an investment that could greatly reduce that tax bill, and you can still get 10% distributions on an annual basis. That is not dependent upon the stock and bond market. Now, that doesn't mean there's not risks. That doesn't mean there's not considerations. That doesn't mean there's not things that we need to talk about, because if you've listened to the show for any length of time, I think, you realize that we talk about the pros and the cons equally. I think maybe we talk more about the cons because I always want to make sure that one thing doesn't happen to me and to my client where they come to us and say, you didn't tell me this. That to me means I'm failing. That to me means I'm not doing my job, whether it's good or bad. I want to make sure that we never have that, that need. So, or have that conversation. So cash flow stories are important, especially in today's market. We had a client this week and a couple good options. One was, a bank note that was paying 10%. It was an 18-month bank note backed by, a huge bank that you know of, 10% annually, paid monthly. So, pretty strong distributions given the current economic or interest rate environment. And then there was a protection bucket. It was a 5-year protection strategy that the principal was 100% guaranteed. And the 100% guaranteed bucket had a lot of pros and certainly some things to think about. And the 10% banknote strategy, certainly had, a lot of pros and some things to think about. And I think one thing that our clients can appreciate and relate to is our transparency of compensation, whether it pays us a fee or it pays us a commission, our transparency of always doing what is in the best interest of the client. I think our job as financial advisors, money managers, whatever you want to call us, we're educators. And we're educating you on strategies that you just simply, don't have a good, true understanding of. If you have if you're not in the business and you can understand 100% of what your portfolio is doing, then you really have a portfolio that's just going to track the market up and track the market down. And you're at the mercy of wherever we're at when you ultimately need that money. And that's not good enough for me. That shouldn't be good enough for you. It's certainly, I don't think, good enough for our clients. So my job with this client this week was to say, here's what both of them are. Here is how we're compensated on each, just to get that total transparency off the table. We don't ever want a client wondering, well, are you recommending this because you're going to get a fee forever, or are you recommending this because you're going to get a commission? And so we just lay it on the line and say, here's how we're paid. Nobody works for free. I've always found that, it's just best to be upfront, because if we can take that thought out of a client's or an investor's mind, then they can make a good educated decision. So we shared both. And at this point, given that he's 5 years out from retirement, a sizable, amount of money to him, and that's different to everybody. When I say sizable investment, it's going to be different to every single listener. Some people think 50,000 is, you're super rich. Other people think you've got 10 million and you're poor. I mean, it's probably not that dramatic, but you get the point. And we always want to make sure that, whatever you have, we think you're wealthy. And so it came down to the decision of, here is the pros and cons to both. Here are the pros and cons to both. And, given your situation, it really is what is going to allow you to sleep better at night. And, and we were able to make an educated decision. And I think that's the level of extent that we go to. It's not just me, people in my position want to seem smart. They want to, wear great suits and have great watches and, the latest this and the latest that, and put together, 200-page pitch decks that make us look really, really smart. And that's just not us. And it's not, I have no interest in that. Been there, done that, very, very early in my career. Now I just want to make you money with the least amount of risk and the least amount of volatility. And I want to make you as much money as I can so you can do things that you may have never thought that you could do, or that you just didn't have to worry, right? We talk numbers all the time. We don't talk, I'm 48, and I don't think, okay, well, if I was 60, I look at, my goodness, we're beating the market by X or Y. And to those investors, that means nothing. What's more important to them is, wow, I don't have to worry. What is that peace of mind worth? And so those are the things that we're doing. 630-492-1912, 630-492-1912. Certainly, get with Paige this week and we can have a conversation. Come into our office. Like I said, our office is headquartered western suburbs of Chicago. So we work all over, Illinois, really, of course, but all over the Midwest and all over the South. And if you're listening to this radio show, that means we have a very large presence in your area, because this show does run in multiple markets. And so we want to make sure that that we're here to help. We want to, again, it's all about hyper personalization. It's just all about what is good for you, not anybody else, because at the end of the day, that's all that matters. It doesn't matter what I think or what I have or other clients have. It's how can we, with the use of cutting edge technology today, deliver the most growth with the least amount of risk or worry, and make sure that we're allowing you to meet your goals, your objectives, and whatever those are in retirement. And so that's ultimately what we want to do. So 630-492-1912. Get with Paige. Visit the website, kuhncp.com, kuhncp.com. When we come back, we're going to talk about protection. We're going to talk about growth and some of the things that we're doing in each of those spaces. So come back with us. And I don't think it'll be time. I think it'll be time well spent. Let's just say that. So more after the break.
Hoping is good. Knowing is better. You are unique, and your investments and plans should reflect that. Investors today want defined outcomes, not investments that simply track the stock market up and down. Did you know most of all mutual funds and managed accounts by prospectus must stay fully invested no matter how good or bad the stock market is? There is a better way. We want our clients to use portfolio gains to compound their investments, not make up for portfolio losses. Schedule a complimentary call with Robert. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
Back, you're listening to Destination Retirement. My name is Robert Kuhn. Thank you for listening. If this is your first time, welcome. If you're a repeat listener, if this is something you catch on the podcast, thank you. It means a lot to us. We certainly see the numbers up and to the right. That's what we like. That's what we like with our money. That's what we like with our investments. That's certainly what we like with the podcast. If you're listening to the show, we are headquartered in Chicago, western suburbs of Chicago. We do have a national presence, though. So if you're listening to the radio show, because it does run in multiple markets, then we do, and we are able to work with you. And if you want to have a conversation about not using a one-size universal portfolio for clients, or working with an advisor that uses a universal portfolio for all clients, if you want to talk about hyper-personalized portfolios that are designed for your unique needs, your unique cash flow requirements, your protection needs, your growth requirements, then certainly give us a call, 630-492-1912. 630-492-1912. And for our Florida friends, welcome you. I'm glad to have our show running in 2 Florida markets. So if you're in the Florida space, don't let that 630 area code fool you or scare you. 630-492-1912. We can meet at our Florida locations as well. So if you want to learn more about how we utilize cutting edge technology to integrate financial planning with portfolio construction that allows us, we believe, to deliver a unique offering, especially in these potentially crazy markets, again, give us a call. So let's talk about protection, what's out there today. Protection, and when it comes to income, it's as we talked about our income labs technology, and that we utilize for every one of our clients. It's very cutting edge. It's very forward thinking. I think that when people are still using the old 4% rule, or they're using Monte Carlo analysis, advisors that are using Monte Carlo analysis, you can ask them, how do you arrive at my income distribution number? And just sit and think, or sit and wait to hear what they say. And they say, well, what software are you using? You should ask that. And if it's Monte Carlo, I think, again, you're leaving significant amounts of money on the table when it comes to distribution. We all want to take as much as we can. And the 4% rule is outdated, way outdated. Monte Carlo is better than nothing, in our opinion, very stale, very dated. And our income labs that you can actually see, our guardrails of the distribution levels that you can take, I think they're going to produce more cash flow for you. And as you know, cash flow is a very, very important part of retirement planning, because if you're one of the lucky few that don't need to worry about cash flow with your assets, well, congratulations. And we're going to really focus more on growth. But if you're one that has to draw down some of your retirement assets to continue to live the standard of living or life that you have become accustomed to, then we want to make sure that you're maximizing those distribution yields. So make sure you get with us, 630-492-1912, and we'll have that conversation. So protection. Oh, man, protection. I think it's when you look at financial planning and you look at investment management, most advisors can articulate when to buy something. Very few can actually articulate when to sell. They'll give you some song and dance on when to sell, and it's just the kind of him and haw, and they don't really give you any kind of mathematical equation of, here's exactly when we buy or sell an investment. Here's when we sell. Here's when we raise cash. Here's when we want to become defensive. And if you're still with an advisor that believes in large cap, small cap, mid cap value, and having to own every single asset class and never, making adjustments based on a calendar, we're going to rebalance quarterly or we're going to rebalance annually. I mean, it's like, what? I mean, that's craziness. I mean, that's 20 years ago. Just look at what's going on in the market today. I mean, you look at the Magnificent Seven and look at the performance that they've derived, that they delivered rather. And it's just, it's so unfortunate that, most people, and I was having this conversation again with my son this week, and in that, our KCP dynamic portfolio, it's a very active portfolio that is based upon themes. And it's based, one of the themes currently is oil. We think oil's going to 100. So how do we get exposure to oil? How do we make sure that, our clients that invest in the dynamic portfolio are going to be able to take advantage of that? And, the problem is in financial planning and investment management is most advisors farm out the money management. And they farm it out to a third-party money manager that runs a massive model portfolio for hundreds and thousands of clients. And, that's, certainly a way to invest. I don't know if it's, the most customized way to invest, but it certainly is a way to invest. But we were having this conversation on why don't more advisors utilize strategies that can be active and can not have to follow the style boxes, that can be momentum driven, that can raise cash when cash needs to be raised. Again, not trying to time the market, not trying to predict the market, not looking into a crystal ball with this hocus pocus of we know where the market's going to be 3, 6, 9, 12 months from now. But there are indicators and technology that give us a good idea of when do we need to play defense and when do we need to play offense. And here's the problem, or here's why it's not happening. Unless it's a belief, first off, it's very hard. Very, very hard to implement. It is incredibly hard to implement, which means it's a lot of work for the advisor. And that is number one reason why I think most advisors don't run the same. They don't manage. I'm going to go out on a limb here and say 9 out of 10 advisors don't manage their personal money the way they manage client money, because when it comes to their personal money, they can just invest. And if they're, they want to raise cash, they want to, take a couple positions into some earnings that, that you can have outsized returns and make excess, risk a little to make a lot, or have some hedges in place to where you can make money if the markets go down. They can do that because it's their own personal money. But when you try to implement that across 500 clients, 1,000 clients, 100 million, 500 million, $700 million that you're managing, it's almost impossible to do unless you want to invest a significant amount of money in technology. But if you're a highly compensated individual and you've maxed out all of your deferred type investments that you can invest in, that may be a great investment to invest in. And does it pay a commission? Sure it does. But so what? Who cares if it pays a commission? Just know what it is and look at the benefit from it. And that could be a very, very great way to grow money that is protected, that you can ultimately take out tax-free down the road. And so I'm thinking, that may only be 1 in 50 clients, or that may only be 1 in 100 clients, or 1 in 10, whatever. But to work with an advisor that just says this investment is terrible because of the name, or that investment is terrible because of the name, it's unfortunate. I promise you that if you ask your advisor what a dual directional note is on the spot, what's a dual directional note, they probably can't tell you. They might Google it really quick and, and look it up real quick while they have you on the phone. But they probably can't tell you. And when you look at, banknotes, you look at structured notes, and you look at kind of defined outcome investing, because that's something that we look at a lot when, again, if you've listened to us for any length of time, we want protection, we want growth, we want opportunistic growth. And inside of those buckets, we're going to look at cash flow, and we're going to look at the growth requirements that are ultimately needed for you. Again, it's that whole hyper-personalized portfolio thing. But when you look at a dual directional banknote, most people don't know what it is. Most advisors don't know what it is yet. It's just that segment of the structured note market. I don't know, 100 billion maybe. Pure guess, maybe more, maybe less. But, it's an investor. Here it is in its simplest form, and in the peace of mind that it can give people. I think if you look at where the market is today, not what's happened yesterday, not what's happened this year, not what's happened the last 10 years, look at the valuation today and look at where we're going to be in 15 months. If I can present an investment from you, and this last week was a JP Morgan dual directional note that tracked the S&P and the Russell 2000, and your maximum growth in 15 months was 19.3. So from 0 to 19.3, you got 100% of that return. Anything over 19.3, you just didn't get. Most people are going to take that, especially when you hear what's next. From 0 to negative 15, you actually got the inverse. So if the Russell or the S&P, whichever is worse, was down 10, you got positive 10. Down 15, you got positive 15. And then if the market or the two indices were down 15 or more, well, that's when you started to lose money. So it was down 16, you lost 1. Down 17, you lost 2, et cetera. Well, guess what? That is a great risk-reward investment. A case could be made, why would you invest in the S&P today at these levels? Or why would you have 100% of your equity market, your equity growth money in that strategy with no downside protection? So it's those types of investments that, when you're working with somebody that, like our firm, that we're always trying to be cutting edge. Now, cutting edge isn't new. I mean, the structured note space has been around forever. I mean, it's $500 billion to $1 trillion a year space. And it may be for you and it may not be for you. And so you can't take what I'm saying as, well, I have to put all my money in it. I mean, there's pros and cons. And my job, as we've talked about a lot, is to really educate you on, what it is and what it's not. So if you have any interest in learning about how you can still make money for some of your money if the markets are down, let's have that conversation. 630-492-1912. 630-492-1912. So protection. So let's get back to protection. Generally, when you look at protection strategies, the trade-off is time. Okay. Anytime you're going to use a strategy that protects principal, there's a time commitment, and they're 5 years, 7 years, 10 years, 14 years, et cetera. A lot like a bond as far as that goes in timing, but there's a 5-year bucket that we're starting to utilize. There's a lot of people that think, whether, they're right or wrong, they think the market's going down, it's going to go down big. I don't necessarily agree with that, but again, it's your money. So people are looking for protection, and there's a 5-year protection strategy that, as I sit here today on this show, is 100% principal protected. It's a 5-year investment. So, worst case over those 5 years, your worst case return is 0. So if the S&P is down 20, you're down 0. If it's down 50, you're down 0. If it's down 100, you're down 0. And as I sit here today, it's capped at 10.25% on the upside. So you're going to get from 0 to 10.25% of whatever the S&P does. So if the S&P does 5, you get 5. 10, you get 10. 10 and a quarter, you get 10 and a quarter. Does 15, you get 10 and a quarter. So for that trade-off, potentially giving up some of the growth, any gain that you get in a year, it's locked in forever for the life of that 5-year investment. So you're not having to play that catch-up game. There's a lot of people that are 5 years out from retirement, 10 years out from retirement, just retired, or in retirement, that they want to know that they want to take a bucket of their money and they want to make sure that it's guaranteed against principal loss. Now, when I say guaranteed, it's not FDIC insured. Okay, that's a big deal. Whoever the backer is, whoever is putting the strategy together, which is the largest banks or the largest insurance companies in the world, you just have to know that. All right, so that's a big deal. But it is guaranteed against a loss. And the question is, well, how can they do that? And it's just all hedging. Institutional hedging is different. You can't do it. If you've got $100 million, you can't do it. It just doesn't matter, because they can create investments that you just simply can't create on your own unless you're a bank. Or but again, if you're looking for some money that's protected, that's relatively short term, that 5-year strategy is pretty good, because I look at it. Everybody loves the principal protection feature. I love the fact that your gain's locked in every year. So if you have a great year, phenomenal. You don't lose, you make money, you lock it in. The markets go down, you don't lose a penny. Then the market goes back up. You don't have to waste time trying to recoup losses. Your gain goes on top of that gain. So if those interest you, give me a call. Set some time up with Paige. With me through Paige, 630-492-1912, 630-492-1912. When we get back, we're going to talk about tax reduction, and we're going to talk about opportunistic growth. So more after the break.
Are you considering buying an annuity? Or did you buy an annuity because you were promised stock market-like returns with no downside? If you own the wrong annuity, there is a great chance you've experienced little to no growth over the past few years. In many instances, the insurance agent received more in commission than many have in actual investment growth. If you'd like to learn more about our annuity repair strategy, please call Robert, 800-674-3217. Again, that's 800-674-3217. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
Thank you for listening. My name is Robert Kuhn. This is Destination Retirement. I'm the president, founder of Kuhn Capital Partners. We're independent. We're a fiduciary. As you know, if you've listened to the show today, or if you've listened to the show in the past, or if we've chatted, everything we do is to build hyper-personalized portfolios that are designed for your unique cash flow, protection, and growth requirements. Everybody's different. I think through the use of technology that is cutting edge, I think when we can take technology and integrate financial planning with portfolio construction, it truly allows us to deliver a hyper-personalized portfolio to every single client we work with, whether you have 10,000, whether you have 10 million. It truly is irrelevant to us. Now, the strategies may change, certainly, but you're going to still get the same intellectual capital, and we're very proud that we are that type of a firm. So with that being said, you can call Paige and set some time up for us to have a conversation. If you're listening outside of the Chicago market, we are headquartered in Chicago, suburban Chicago, western suburbs. We do have a national presence, especially given the fact that many of our clients are commercial airline pilots, Southwest, United, and American. So if you fly for one of those airlines, make sure you reach out to us. We know the system, and we've been in that segment for many years, and we know our competition, and I think you're going to find and be very pleasantly pleased with our offering. But if you are listening outside of the Chicago market, make sure that you understand, because this does run in multiple markets, that we have a presence there, and we want to make sure that we're that we're here to help. So 630-492-1912. So, growth. So let's talk about growth, opportunistic growth, and tax reduction. So we'll start with tax reduction. If you've listened, if we've talked, I think it's the most overlooked area of financial planning, especially in that $500,000 to $10 million space. If you have, $500,000 to kind of $20 million of investable assets, or you make, $500,000, $1 million, $2, $3, $4, $5 million a year. If you have a company that you currently own, or you're looking at through an exit strategy, or you have a lot of restricted stock, basically you make a bunch of money. Tax planning and tax reduction is an area of expertise that we bring to the table. And it's not matching gains with losses, or tax loss harvesting, or, trying to max out, all areas of tax deferral investing. Anybody can do that. You can do that. You don't need us to do that. The strategies that we're talking about are strategies that take advantage of the tax code, and the tax code is there, and there are certain segments, certain industries that you receive significant tax benefits from investing in. And some of those strategies that we utilize are reducing your taxable income substantially to the neighborhood of 50 to 75 to 80% of your investment. You can reduce your taxable income. Now, again, I'm not a tax professional. This is general, but this is part of financial planning. So anything you do when it comes to taxes, it's always smart and good to run by your tax advisor. If you have one, if you don't, we certainly can provide some names to you to talk to. But strategies that if you invest $100,000, you can reduce your taxable income by $50,000 to $75,000. So if you sold a building, sold a business, make a bunch of money. Obviously, those are good investments, potentially, but they're going to reduce your taxable income substantially, and they're paying very strong distributions in the neighborhood of 10 to 15%, and they're not dependent upon the stock market. So when we look at tax investing, one of the benefits of being a fiduciary and being independent, and we have access to strategies that if you're working with a big national brokerage firm or a big national bank, they may have access to, but you're never going to get them because they don't allow their advisors to offer them. Yet many of them underwrite those same strategies for the firm, but they're not going to allow their clients to invest in those. So, again, real strong strategies, especially if you want to reduce taxable income. Give us a call, 630-492-1912. Let's have a conversation about the pros and cons. When it comes to growth, And when it comes to opportunistic growth, if you have a net worth north of $2 million, not including your home, we need to have a conversation. The KCP Opportunity Fund, it's a fund that I'm the portfolio manager of. It's a very momentum-based strategy. It's a strategy that we're there to take advantage of mispricings in the market. This is kind of your opportunistic bucket. Again, most advisors fail when, in that kind of 5 to 10 to 15% of money that we really want to chase returns. It's not, gambling. I mean, this is all, in some form or fashion, mathematical or chart driven. But, if we can do market plus 20 or market plus 50, those strategies they do exist, and doesn't mean there's not risk, of course, but that's why we're using it in proportion to your overall assets of 5, 10, 15%. But those are strategies that we're looking for momentum, and we're looking for near-term momentum. And with computers and with technology, and you look at what the big banks are doing and the big institutions and the big hedge funds and that money that is chasing that money, it just continues to push the money up. I mean, look at Meta and look at the Magnificent Seven and look at Nvidia and you look at all these names that have just made so much money this year, and everybody is just can't continue. Well, that was 50% ago. That was 100% ago. And so when you have risk strategies in place, where you have hedges in place on the downside that you can either make money or you can get out, or you can actually hedge, certain investments, that opportunistic bucket is something that we're very, very passionate about. And, most advisors, again, they just don't have that opportunistic bucket. They just don't have it. And so it's unfortunate. But again, if you have a bucket of money, a net worth north of $2 million for that investment, or you have $1 million with our firm, then we certainly need to have a conversation. Let's talk about it. Let's show you, the returns, and let's show you what it is, what it's not. And, we certainly would love to have that conversation with you for some of your money, because there's a tremendous amount of money to be made. And I think when you listen to radio shows, a lot of times it's doom and gloom, and it's, you have to protect, and you can't, the market can't continue to grow, and, the markets are up so much. And well, here's the news flash. I mean, yeah, the markets are up a lot, but if you look at history, when the markets have done what they're doing, they're going to, 8 out of 10 times, they're going to continue to go up and go up and go up and go up. And you have to take advantage of that. I mean, at least for some of your money. So, I think, again, when we talk about hyper-personalized portfolios, cash flow protection growth, and then opportunistic growth. And so everybody's going to be different. Every percentage is going to be different to certain strategies. But, again, like I asked you before, to ask an advisor that you're working with, where is my bucket of money that's going to make money if the markets go down, at least to a certain point. And if you don't have it, we got to have a conversation. Another question is, where is my 5 to 10% that we're chasing returns? Now, again, it's not going crazy, but we're doing, statistical, mathematical analysis on, where the money flow is, what is going to give us the best near-term opportunity to greatly exceed the market. Where is that in my portfolio? And again, they're probably going to tell you don't have any, or they're going to probably tell you why it's not good. I mean, that's another thing in this industry. If an advisor doesn't bring you the idea, it's not good. Just know that going into any conversation you have with any advisor, if they don't bring you the idea, it's not good. Doesn't matter if it's 50% a year guaranteed by the government, it's not good because I didn't bring it to you. So anyways, hopefully you got a lot out of the show. As you know, we're all about building hyper-personalized portfolios with the use of technology. I think cutting-edge technology can increase your returns, reduce your risk, give you more cash flow. That's what we're doing. And if you have any questions or you want to have a conversation with us, it's really simple. Give Paige a call, 630-492-1912, 630-492-1912. Make it a great week, and we'll talk with you again next week.
Thank you for listening to Destination Retirement. Don't pay too much for taxes or retire without a sound retirement plan. For more information, please contact Robert Kuhn from Kuhn Capital Partners. Call 630-492-1912 or visit them online at kuhncp.com.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guests unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.